Welcome to the Australian Property Podcast, helping you achieve success in property. Featuring your host, Jonathan Preston.
Hi guys, thanks very much for tuning back into the show. So in today's episode, I want to talk about where the yield curve is forecasting that interest rates will move from here. If you'd like to get in touch, send me an email at jp@australianpropertypodcast.com.au. All right, let's get started. All right, so to talk about the yield curve, basically to define what the yield curve is, I guess, to get us started, that's basically sort of a graph which shows where the financial markets are expecting interest rates to go. And this is determined by current bond valuations. So bonds being, where there's like a loan typically, where money is being lent to the government. And this, these are at various durations. And where these are priced basically indicates where the interest rates are forecasted to go. This is typically a good indicator as the people who buy and trade bonds, tend to be financial institutions or very high net worth investors, and these people are, typically very much in the know, and these are the people that are, you could almost say, controlling the markets in some respects. So these are not like amateur forecasts. These are, the people who are playing with the real money, where they expect things to go. So historically, the yield curve is one of the best indicators of where the markets will actually go. It's not perfectly accurate, but it's perhaps more accurate than your average, commentators' forecast as to where rates are going to go moving forward. So to talk about where, the yield curve is pricing, the next meeting in February, they're pricing only a 5% chance of rates going down. So it is expected that, rates are almost certain to stay the same at the next meeting. In terms of, where it's forecast over the next next year or two, basically, the RBA rate is priced in to decrease slightly going toward the middle of the year, and that's bottoming out in July. However, rates aren't actually expected to go down all the way to 1.25%. Forecast is only a little bit of a chance of going below the current rate. So the yield curve is basically pricing a chance of a rate cut, but the full cut is not expected yet. So they're not saying that there's going to be a partial cut. What they're saying is that there is a chance of a rate cut, but they're not completely expecting it as yet. So they're, and if it were to happen, the bottom of the market is forecast to be around that July timeframe. Basically, around there, it sort of bottoms out for a few months, and then after September, the forecast is for rates to start to rise. And basically, by June 2018, the yield curve currently indicates that the RBA is highly likely to do a rate rise of 0.25, and that's by June 2018. So the likelihood they're expecting of the rates to go up, starts to increase toward the end of the year, and they believe, there is a pretty likely chance that we will see a rate hike by the middle of next year, basically. This might, I guess, from initial inspection, sort of sound negative, because, as investors, having that investment debt, with rates rising, it means that, the cost of holding that debt will increase, which is obviously not good as an investor and can stop, people going into the market. But what it actually indicates is that there is strength in the economy, and that's because the RBA will not increase rates unless the economy can withstand it, and basically the investment markets, will potentially, the welcome might not be the word, but can withstand this. So, the RBA isn't going to just start pumping the rates up to the detriment of the economy. It's a careful equation that they have to balance here. It is effectively stimulus when they keep rates at these low levels, and they are mindful, I guess, of the balance that they want to stimulate the economy as a whole, and a lot of the economy, bar Sydney and Melbourne, isn't really that strong right now. And so that is kind of the argument for keeping rates where they are. But if they were to independently manage the rates per state, Sydney and Melbourne would most certainly have higher interest rates right now. So those are kind of the things that they're kind of juggling at the moment. And looking at where the markets are going, they're obviously not too concerned about house prices falling right now, but at the same, their concern has more been toward the upside. But obviously APRA's intervention has helped a little bit there in terms of putting the cap on the investment lending and having the floor rate in terms of the assessment rate for mortgages and everything like that. But more or less, there is the next direction is indicated basically to be higher. In terms of, whether this is going to affect house prices negatively, so my research over many years, I've been following this for probably 10 years now, indicates that basically the markets tend to keep rising, and this isn't just the Australian property market. I refer to the S&P 500 and other investment markets around the world. Basically, indices and asset prices, risk asset prices, tend to keep increasing over time as interest rates rise. And this is because, as interest rates rise, that's an indication that things are very strong. So while it does get more expensive to hold assets, this may be somewhat offset by the inflation that is, forecast, and the inflation that will potentially take place. And that can be, there can be an increase in wages, and it's expected that asset prices will continue to move with that. If the economy takes a nosedive and asset prices start to, decrease, then rates don't keep going up. The central bank is going to turn around and stop them and potentially cut rates again. So that's basically, how it sort of works. The other thing is that while we might have seen the bottom in terms of rates, at least that the banks are offering, while we might, there's a chance of another rate cut, even if that were to happen, I would expect a muted effect on actual rates that we pay, particularly as investors. If anything, they might do a small movement on some owner-occupied rates, but largely we've seen the banks move independently of the RBA in recent times. So I can't imagine that they're going to turn around and do a full 0.25 cut. In fact, I would highly bet against that. In terms of, from where the interest rates bottom until the top of the market, typically it's like a 4-year plus cycle. So if we were to say that the bottom on interest rates was, let's say, maybe the December quarter of last year, potentially, say, 2-3 months ago, that potentially would give us a guiding point. So if we look at, let's say, November 2016, 4 years from then would be, the end of 2020, which seems like a far way away. But the reality is that it'll come around quickly. But, that is still a couple of years away. So we could see, growth over the next couple of years, and I expect that will be the case. And so it's unlikely that rates are going to turn around and get to a peak very quickly. And basically, if you look at the history of investment markets when rates are rising, typically rates are rising because the economy is strengthening and asset prices are strengthening, right? Now, asset prices tend to grow at the fastest rate toward the end of the cycle, not actually at the beginning. Now, this doesn't necessarily mean that everything's going to move together, but, when it comes to investments, things tend to move in a boom and bust kind of fashion. If you look, over, say, a 20-year scale, things tend to balloon up and then they kind of pop and go down for a couple of years, and then they start to go up again. Now, it's obviously very hard to time the bottom and the top But the biggest gains tend to be toward the end of the cycle. So I would expect that the next couple of years, if we do see the economy become strong enough and the RBA starts to increase rates steadily, then we'll probably see house prices actually continue to rise significantly higher. You've got to also look at compounding growth as well. So let's say we see a 10 to 20% gain over the next, say, 3 years. That final year that might do a 15, 20% gain, you've got to remember that that's going to compound on top of the 3 other results that we've had in the 3 years prior. So the end result ends up being massive, but then you've got to realize that we may see a downturn which could pull back and take away 20 to 50% of the prior gains, and that again is potentially going to be the next buying opportunity. But are you going to wait that long? In that time, and as I said, 4 years tends to be a minimum. So if you're going to leave 4 years of 10 to 20% compounded gains on the table, and let's say it goes for 5 to 7 years, you might have missed a significant portion in your life. And you may be priced out almost forever after. So it is very hard to time that specifically, but I'm thinking that right now, if the rates do start to go up, it's only going to be because the economy allows it, and as a result, I'm expecting the next couple of years to be relatively prosperous. I would say a good place to be positioned right now would be if you are in strong land value holdings in sort of scarce areas within commutable distance to major cities, and as long as you can afford to hold it when the rates do go up a little bit, then the next couple of years I'm expecting should be quite profitable for you. So I really appreciate you tuning in today, and look forward to seeing you back soon. Thank you. Thanks for listening to today's episode. Please subscribe to the podcast, and if you've enjoyed the show, I'd really appreciate it if you could leave a review on iTunes and recommend the show to any friends that you think might benefit. Thanks again for listening, and we hope to see you back soon.